So let's start right on time, 12:15 on this Wednesday morning. Welcome everybody to the 8th Frankfurt Conference on Financial Market Policy, Part 3. This is Andreas Hackethal from the House of Finance. I have the pleasure of moderating this session and doing the warming up, introducing the panelists and also some slides with some facts. So the question today is, as you can read, is how should an effective stimulus package look like? And stimulus in that sense, and that's the overall title, household consumption. So what has the corona pandemic, first wave and all the measures in between taught us in terms of how can governments boost consumption? Consumption has dropped dramatically, and it has been boosted by some measures, but these measures have been very differently across countries and also their effectiveness. So that's the key question of today's session. We have expert people in the panel. So here are two of the four. This is Maarten Dossche. Welcome, Maarten. Say hi to the 36th floor, as I just learned, of ECB. So you're at DG Economics. You're an economist there in several functions, but now in a business cycle analysis division. So that's, of course, very fitting. Great to have you here. Thank you. Then we have Philipp Mohl, who's with us by phone. And he is an economist at the European Commission, DG Economic and Financial Affairs, and in the Fiscal Policy and Surveillance Unit, sharing his views from Brussels or from wherever you are at this point in time, Philipp. Also glad to have you here. And then we have two academics, Michael Weber from Booth School of Business, Chicago. Right now, despite your background, I assume you're not too far away from me here at the House of Finance. Glad to have you here. You are a professor of finance at this prestigious school and are affiliated with many of these institutions that you can see on the slide. And finally, Alexander Ludwig, who is a macroeconomist here at Goethe University and a fellow of SAFE Leibniz Institute. I guess you're in Barcelona right now, sharing your views, not only sharing your views, but also aiding me, or I assist you in posing questions to the panelists later on. Talking about questions, this is a format where you are invited to pose your questions in the Q&A, or if you have a German Zoom, in the F&R section, and we'll make sure, Alex and myself, to have a look at them, and then you can, all the others can also vote questions, so we take your questions later on to the panelists. So, welcome once again to everybody to this SAFE policy conference, household finance. So we're taking on the perspective, or we are focusing on this sector of the economy, asking questions. As you know, there's microdata, macrodata, and so on. So to warm up, I prepared some slides myself, and I want to show it to you, just some numbers and maybe also some structure that we can impose on the discussion later on. So first of all, not surprisingly, as I indicated earlier, and as you all know, consumption plummeted dramatically. And here I have some numbers for different countries for Q2 2020 compared to Q2 of 2019, minus 10% in the US, minus 11 in Germany, up to minus 25 in the UK. And in particular, services consumption was down. You see even higher numbers on the right-hand side. Now, there are many reasons why consumption dropped, of course, and here are 5 channels, and 2 of them are supply-induced. So that's the supply side, simply due to the shutdown. Households didn't have the opportunity to purchase particular goods. So in particular, those that require in-person contact with shopkeepers and so on. So this is about 40% of total spending that requires personal contact. So which households are affected? More or less all. The second, also supply side induced, is all these people who had shocks to their income or lost their job have less assets to spend. So all those households that work in shock industries may hit constraints, and so one implication is that they cut back especially on non-essential goods. Then we have 3 demand-induced channels through which demand and consumption is affected. 1 is health concerns, or 3 is health concern in general, but this refers to the negative side, namely health concerns. Even if shops are open, people might incline to go less shopping and thereby reduce their consumption. On the positive side is more online consumption, which we have observed. And the final channel is if people are very pessimistic, or especially those households who are pessimistic, they might reduce consumption, especially in non-essential goods, and rather save, precautionary saving. So these are different channels with different policy implications also. And here's some figures already taken here from the US, as most evidence is from the US in most papers, is that if you look at household groups, and here it is sorted by income, so the top quartile income of US households, they reduced their consumption by 39%, or no, sorry, they reduced their consumption, and this reduction accounted for 39% of total consumption decline, whereas the lowest, the bottom quartile, their reduction in consumption accounted only for 13. So you already see that there's different households and groups of households responsible for different shares of the total decline in households. One number that we got ourselves from surveys, this together with the research institution, market research institution Nielsen. We have a website at SAFE called Haushaltskrisenbarometer, and there we found out throughout the entire year that it was 80% actually of households didn't experience any income decline, and the majority who had plans for larger purchases did not postpone and held on to them. So here we see there's this bifurcation also in households, in particular in Germany, that some kept on as before and some were really strongly affected. Keep that in mind. So here's another slide with some of the studies, actually also one from Michael, who's here on the panel. But in general, income assistance programs, what we have seen is income replacement, especially for those in Kurzarbeit, so furlough, and then secondly, direct cash transfers, in particular in the US, and Michael will tell us more about this. And then extended unemployment benefits for those who lost their job or lost their job before. And then finally, a fourth one, which is not a direct assistance, but which is value-added tax reduction, as you all know, but for example, in Germany, down from 19 down to 16%. So if you look at the literature, and actually Annika Weber and myself, we prepared a paper which is on the SAFE website, which is a 15-pager just summarizing what we know so far on the empirical evidence. And here are some examples of the so-called MPC. So if households receive an extra euro or dollar, how much, what share of this is then consumed, which is of course the whole idea of these boosting programs, that households take the money and turn around and consume. And you see vastly different numbers. So for hand-to-mouth consumers who receive money, they spend most of this. So the MPC right in the middle, and in particular on essential consumer goods, 68%. Whereas for people, and that's another paper, Baker et al. For the US, once again, people who have liquid assets in excess of $3,000 US dollars, their MPC actually from this particular program is virtually zero. So that tells us a lot about if programs shall, beyond helping people, of course, in the first place, but shall boost consumption, it makes a big, big difference what kind of programs are launched and to which households they are targeted. So my last slide is maybe some food already for the later discussion, namely challenges ahead. So even if we look at the evidence, and this is very informing of what we learned, the lessons that we learned over the last couple of months, then of course right now is a different, or might be a different game. So number 5 is consumers might have updated their belief and think about precautionary saving or health concerns differently than a couple of months ago. Then, of course, number one, that's an obvious one. We cannot go on with these programs without looking at the fiscal implications, because it depletes, of course, fiscal buffers fairly quickly. Then one aspect is also, especially these unemployment assistance, that it might hamper adjustments in labor markets and so on. So I do not want to add too much, but one last point here is namely what we learned through this crisis, and some researchers have exploited this more or less real-time data, transaction-based data, or data on mobility, which is very informative for policymakers when it comes to immediate or contemporaneous learning about what is going out there. And there's not too much data on Germany, but we were lucky to have access to transactions or checking account data on a large sample of more or less representative Germans. And I just want to give you this, it's actually not descriptive, it's a panel. And what we estimate is what is the effect on daily consumption from the lockdown. So we have different states, Bundesländer, and we have a dummy. And this is the lockdown period, and what we observed here, and this is more or less consistent with the macro data, is that overall for the sample clients, once the state goes in lockdown, the daily consumption, as we measured here through the checking account, is reduced by roughly 10 euro. And most of it is actually because people withdraw less money, as you see, minus cash. But one aspect or one consumption area goes actually up. This is internet, or this is e-commerce, which shoots up by over 100%. And this can be done more or less in real time. And I guess, and I hope and figure that over the next months or so, this type of data will prove helpful also for policymakers. So with that, I like to hand over to Maarten, if you wish. And Maarten from ECB, and actually you have some pan-European data also that you want to share with us. So thank you very much for sharing your thoughts and your slides with us.
So thank you, Andreas. I think you can hear me. So thanks for the invitation to you and the team. It's a pleasure to be on this panel. Before I start, I can already let's say the usual disclaimer that these are my personal views and that they do not necessarily represent the views of the ECB. And what I will present today is a summary of recent work that we have done on this topic, together with the colleagues mentioned on the left here at the ECB. So what I would like to do today in the next slide is give you a bit of an overview of what is sort of a summary narrative of what has, let's say, happened to the household sector and to private consumption in the euro area, and how it can help us, let's say, also form a view on the question that you highlighted at the beginning of the session. So I'll go through, let's say, 3-4 facts, show you how it's developed, also the changes in consumption and the saving rate, and also delve a bit deeper into the, let's say, the heterogeneity with which this sort of multifaceted shock has actually impacted the economy and the household sector. And what we find is that indeed precautionary savings have increased to levels similar to the great financial crisis. So savings, let's say, induced out of fear for future, let's say, income or job loss. But then the new element, if you like, and you've already touched upon that before, is some sort of, let's say, involuntary or forced savings, in particular on behalf of higher income households. And here, what this represents is both people, let's say, not being able to go to restaurants because they were, let's say, closed by regulation, or also because people don't feel comfortable anymore to go to restaurants because they are afraid to get infected, let's say. So that's a new element, obviously, here in this discussion. And then when we let's say dig deeper into the data, also using our new pilot consumer expectation survey here at the ECB, we find, let's say, at least evidence here that targeted government transfers must have helped in protecting consumption of lower income households, and therefore, I mean, also aggregate consumption, if you like. So in the next slide, I show you, let's say, a decomposition of disposable income. On the left-hand side, you have the euro area, and on the right-hand side, you have a quick, let's say, comparison with the United States. And I'm sure that Michael will dig deeper into that later on. But I thought it was interesting to just put the two economies next to each other. So you can see that the red, let's say, contributions to disposable income have been negative. So the compensation of employees has gone down, obviously. And what's maybe also interesting or good to keep in mind is that the COVID shock, let's say, reached the euro area economy and Italy in particular a bit earlier than in the US. So that also is, I think, reflected here. But what's, I think, more interesting for us today is to see the big difference in terms of the government transfers or the government intervention between the two economies. So the light blue contributions show you the contribution of taxes and social contributions and transfers to households. And obviously, they have buffered the drop in disposable income in the euro area. But let's say the programs that were put in place in the US have been much bigger in size, and presumably, or from my reading of the literature, also less targeted than some of the prominent programs that we know from the euro area, in particular the short time work schemes, which let's say are more of a conditional nature. So in my next slide, I briefly decompose the rise in the saving rate on the right-hand side for the euro area. And there, using, let's say, an off-the-shelf saving rate model by Mohl et al. That they developed, let's say, for the great financial crisis at the IMF. And what we find is that indeed, let's say, precautionary savings out of, let's say, income concerns have risen with the shock. But this can in no way explain the rise in the saving rate that we have actually observed. So there is this big residual that this model cannot capture, and that's obviously something that is related to COVID and let's say the lockdowns and the concerns for being infected, and how that has then also impacted people's consumption. Now, there seems to be a lot of heterogeneity in how people's income and consumption has been impacted. And in the next slide, I show you on the left-hand side, basically what share of consumption has been exposed to lockdowns or to the kind of restrictions that people have been submitted to in terms of their consumption. And it seems that the let's say households in the higher income percentiles, that their consumption is actually more impacted because they consume more non-essential, in particular services, like, let's say, holidays to far destinations and so on. And those things in particular have been, let's say, restricted. So there is, if you like, a progressive impact on consumption. So higher income households had to cut back their consumption by more in percentage terms. Now, in the sectors that have been in particular affected, like the services sector, those sectors employ more, let's say, lower income households, and that's what you can see on the right-hand side. So there, the impact in terms of exposure of your labor income to the shock is more regressive. So in the lower income households, you can see a bigger exposure to the COVID shock. And that has, if you put these two elements together, that has also led to a very, let's say, heterogeneous developments in terms of household savings. So in the next slide, on the right-hand side, you can see evidence from a very nice paper of Bouni et al. On French data, where they look at the so-called excess growth in net financial wealth across expenditure deciles. And what you can see is indeed the confirmation of what I was explaining earlier, that the savings that have been accumulated over the period of between February and August have been concentrated among the higher, if you like, expenditure or income percentiles, and that let's say in the lower end of the income distribution, people even had to let's say draw on their savings or borrow to let's say to cover their spending. So that's a bit let's say how this is being reflected in savings. And what we see from the aggregate data on the left-hand side is also that a lot of these savings, or actually most of these savings, have been accumulated on people's deposit and current accounts. So this is also yeah, let's say consistent. Now, when it comes to the effectiveness of government transfers, in the next slide, you can see evidence from our new pilot consumer expectation survey, which is fielded in Germany, France, Italy, Spain, and the Netherlands and Belgium. And what we find there is that if we ask people about their reaction in the numbers of hours worked to the COVID shock, is that again this sort of regressive pattern where people in the lower income deciles have been disproportionately affected by the shock. Now, when we ask the same group of people also about whether they have received any sort of government support in response to COVID, it also seems that the let's say the government support has ended up more in the lower income brackets, where the biggest impact has also been felt. So in a way, this is evidence for, let's say, the targeted nature of many of the programs that have been in place in many countries of the euro area. So of course, I mean, we can discuss about different programs, and some will be more or less targeted, but this is sort of the overall picture, if you like. And of course, I mean, keeping in mind that that people in the lower income brackets typically have higher propensities to consume and are typically more liquidity constrained, and which is what you can see on the right hand side. This obviously has then, let's say, more impact on private consumption and on aggregate consumption, if you like, through higher multipliers. So this is a bit, yeah, how we see the picture in terms of, let's say, a short narrative for the euro area. Overall, it seems that there's been a very heterogeneous, let's say, impact on consumption, on income, on savings, and that overall the households receiving income support are not necessarily the same households as those that have been accumulating excess savings over the past, let's say, 6 to 9 months. So that's a bit, in a nutshell, my, let's say, summary. Thank you.
Thank you, Maarten. This very interesting. I suggest before now posing question to you, let's go on with Michael and then do it in a joint session. Yeah.
Yep.
Okay, Michael, if you wish.
Perfect. Okay, so thanks a lot, Andreas and Alexander, for asking me to be part of this panel. And Maarten, you're right, I could have talked about heterogeneous spending responses in the US, but I was asked actually to talk about two specific and different policies, in particular about using changes in consumption taxes for stimulating demand, and also how fiscal stimulus payments directly directed to households affect their spending, savings, and consumption decisions. And so I went back to some of the work we've done using German data. So this is from a paper with Francesco D'Acunto and Daniel Huang, where we actually studied two different unconventional policies, actually using data from the European Commission, which was collected by GfK for the case of Germany. And so the way actually I first want to spend a minute or two briefly actually, through a lens of a theoretical model, how actually changing consumption taxes could potentially be effective in stimulating demand. At a very basic, simple level, you can think actually that this, what we had labeled unconventional fiscal policy, can replicate what monetary policy typically tries to do in a period when conventional monetary policy is constrained by an effective lower bound on nominal interest rates. So imagine you're a central bank, you want to achieve negative real interest rates to induce consumer spending and firms investing more, but somehow you cannot do that because you cannot lower rates below a certain level. So therefore, one way to actually engineer negative real interest rates when actually nominal rates, let's say, are stuck at zero, is just to get a path of increasing consumption taxes. Now, if I know as a consumer in 12 months' time, consumer taxes will go up by 3 percentage points. Let's say, I don't know, maybe it makes sense actually to consume now before prices go up. And that's actually a very simple and straightforward policy. I can tell it to my grandma. She understands before things get more expensive, I should out and consume. Now, of course, we all know that Germany implemented effectively this type of policy. They on impact lowered consumption taxes in July, and now in January they go up by 3 percentage points. So maybe before things get more expensive, we might want to go out and consume. Of course, if you want to analyze this policy right now, lots of other stuff happening. So through the language of an economist, there are lots of confounds, really hard to get some causal, meaning relationship between how this policy works and how it affects inflation expectations and spending. That's why we actually went back to a very similar policy episode, which was, however, not hampered by lots of stuff happening at the same time. And if you remember the first Merkel government, when they formed or signed the coalition treaty, they announced in November of 2005 that they want to increase value-added tax from 16 to 19%, however, only effective with a 14-month lag. And then if you study actually how Germans reacted to that policy, there's you might not be familiar with the GfK Konsumklima Index. That's just the micro data from that very index. And you look at what do Germans on average think will happen to the inflation rate over the next 12 months. You see, once the increase of the VAT comes closer, inflation expectations go up. And then, they start plummeting once actually the increase is effective. And similarly, do you think it's a good time to purchase larger ticket items? And again, you see that actually on average, there's this large increase in the willingness to buy, and then things get more expensive and the willingness to buy goes down again. Crucially now, you can see that also in realized durable spending, so not only in the survey, but also in realized spending. And you can also actually establish a causal relationship of the policy by actually matching the microdata for Germany to households that were not affected by the policy. Think about households in France and similar countries. And then you can actually establish that indeed it looks like in an environment where not lots of other stuff that might actually complicate identification happens, a measure that actually uses changes in consumption taxes over time to engineer an increasing path of future prices can be effective in stimulating demand. Now, what I also want to just contrast here in this figure is another alternative policy that at least theoretically should operate via the same very channel, the so-called consumer-Euler equation, but instead actually, which we argue in the paper, is way more complex to understand. But what we plot here is just the first two announcements of forward guidance by Mario Draghi in 2013 and 14 using the same microdata from Germany. Similarly, you can do that using other European countries. And here, if I tell my dad, Mario Draghi just said that he'll keep interest rates at or below zero until the end of the liquidity trap, you would have to understand this will generate inflation in the future. Therefore, today he had to update his inflation expectations already and go out and consume more. But of course, you see in the data, ordinary households, they actually don't really make this tight connection. At least in the model, it should actually, on the right-hand side here, work exactly as on the left-hand side, but it looks like actually there's certainly a role for complexity and simplicity of policy. And I want to reiterate that in the next couple of slides again for determining the ultimate effectiveness of different policies when it comes to stimulating household spending and expectations. Now, the crucial point also is that if you were to look at subsamples here on the left panel for this unconventional fiscal policy, any heterogeneity cut you look at by demographics, college, non-college, high income, low income, young, old, husband, wife, and so on, anyone in the data reacts similarly, which indicates that simple policies are effective on stimulating the demand of every German in this case. And of course, then you don't have to be concerned about redistributive effects and other type of mechanisms that we typically actually don't even have in our models. Now, of course, for this policy to be effective, you have to ensure that changes in taxes transmit into consumer prices, and there's now some early evidence from work of Monika Schnitzer and Clemens Fuß that seem to suggest that at least the cut in taxes in July were fully transmitted into retail prices. Now, just to reiterate this idea that complexity matters for the effectiveness of policy, and therefore later on I want to actually reiterate that by actually making some direct suggestions. Here is just some data from Finland we've used in a recent paper. And the nice feature of Finnish data that is pretty much you can observe whatever you want to observe by individuals and then also merge that at the individual level. And here we have used measures of IQ from the military at the individual level. At the age of 19, we're able to use again the same European Commission data for Finland, and we just studied, a host of outcomes. And what I'm plotting here, this is just, how well are individuals at forecasting inflation. So, what do you think will inflation be over the next 12 months? After 12 months, we as researchers, we observe inflation, and we look at the forecast error, and then we can look at the average forecast error by IQ. One means within a cohort, lowest 4% by IQ in Finland, 9 means highest 4%, and then it's just a discretized normal distribution. What you see here is that, there's a huge heterogeneity in the ability to forecast inflation. The lowest 4% by IQ make a forecast error for inflation that is about 2.5 times as big as the highest 4%. They also do not tend to react to fiscal and monetary policy measures. So therefore, there is this role of actually explaining in simple terms what policies aim to achieve to enhance its effectiveness. Now, this is some data from a recent paper with Oleg Korbyo and Yuri Godnichenko. Given that we are not as good in producing figures as are the graphic editors of The Economist, I actually just used their plot of our paper. And so what you see here is just, which fraction of a stimulus check did households consume, save, and use to pay down debt by income. And so anything that is blue is actually just some form of consumption. Anything that's red is savings. And anything that is yellow in between is pay downs of outstanding debt. And so the only thing I want to take you away from here is that you can see, and this is what Andreas highlighted earlier already, low-income people, hand-to-mouth consumers, those that live paycheck to paycheck, they tend to consume, let's say, 2/3 of the check they receive, 1,500 per person, plus additional 500 per children. And instead, the higher the income, the less binding financial constraints there are, the lower is the fraction of spending. Now, of course, there are many reasons why we might see that in the data. On the one hand, there's just restriction to spending. I cannot go out and fly to, let's say, the Maldives or so, and stuff like that. I might have health concerns and so on, but there's also definitely evidence that just sending unconditional checks to anyone, and so I have to be clear, in the US, there was a cut on household income of 150,000, but nevertheless, still pretty high income individuals received stimulus checks, seems to have a decreasing marginal effectiveness if your aim as a government is to stimulate demand, which of course as we discussed earlier, might not be the ultimate aim, because you might not want to have consumers going out and engage in social consumption. So I think that's something we have to keep in the back of our mind. But it looks like if you want to actually do that, you might want to have a bit more targeted payments. And one way of possibly doing it is, of course, to target payments to those that actually saw actual cuts in their income. So you had this extended UI benefits in the US, but even there it was rather untargeted. And some colleagues of mine at Chicago Booth, they have actually a very nice paper that document that the median replacement rate of income due to additional UI benefits was actually 145%. Might actually remind many of us in Germany of what's currently happening with restaurants that get 75% of last year's sales without actually any cost potentially occurring. So of course, we might want to think about more targeted policies. And so now let's just come back to one point I made earlier. So the role of simple, crisp, and effective policy communication. This is from some work we've been doing recently in Finland, where we did what's called a randomized controlled trials, just randomize different pieces of information. Information in our setting was tweets by Olli Rehn, the governor of the Bank of Finland. One set of households received a tweet that was about a very technical term and policy instrument, the PEPP, that was 750 billion euros to save the economy, versus the other was just simply, in the words of Mario Draghi, will do whatever it takes to save Finnish households. And so you see, if you just simply ask people, do you think that this policy measure benefits households in Finland? And 7 means that it will benefit a lot. 1 means it benefits a little. Just telling households without even maybe specifying how you do it, just, we'll do it, and trust me, it will be enough. It seems to actually increase the optimism on the part of households versus using technical language and terms that many households don't even understand, even though it includes big numbers, doesn't seem to be effective. And then, of course, in the paper, if you're interested, we also go way more quantitative, but it's just to show you qualitatively that there seems to be this scope for simple, crisp, and potentially also, not super precise language, just to actually raise the level of optimism of households to get them out to consume more. So that's pretty much all I wanted to share.
Thank you so much, Michael. And with all the misery that the pandemic brought over us, it has brought a boost to academic research. I mean, I know that you are productive, but you have been extra productive with your colleagues over the last months. So congratulations on all these exciting results. Super. Okay, let's move on to Philipp. Philipp Mohl from the European Commission. Can you hear us, and are you there still with the phone? So you're
I'm
not
still
sharing
there,
slides?
and I hope you can hear me.
We can hear you. Very
Excellent.
good.
Thank you very much for the invitation. It's a great pleasure to be with you and to discuss this very important topic. Of course, also in my case, the usual disclaimer holds. I'm representing my personal views, which not necessarily are those of the European Commission. So I see my role in this panel as giving a bit more, let's say, we have discussed in detail the micro perspective, and I try to complement a bit with the big picture, so to speak, from the macro perspective. So my talk is structured in 3 parts. I will very briefly give a short, share our views on the economic context. I will then share with you our thinking on the implications of COVID for the design of the fiscal stimulus measures. And I will finally present the key measures taken both at the national and at the EU level following the COVID crisis. In terms of the economic context, we all know that the COVID pandemic is a severe challenge for Europe. According to our latest Commission forecast, we expect that real GDP declines by 8% in 2020, and then only rebounding in 2021-2022. But we still expect that in 2022, GDP will be below the pre-pandemic levels. We expect a negative contribution to growth, in particular from domestic demand. And here we discussed already before, quite detailed, that the main driver is private consumption as we see it. And according to our shock decomposition, we see that the dominant factor is coming from forced savings. That means the missing opportunities to spend, and only a smaller impact comes from precautionary savings. Of course, lockdowns has also an impact in particular on investment, and our forecast is surrounded, of course, by a very high degree of uncertainty and risks. The risks are tilted to the downside. Now, in terms of the general thinking, the implications, my second point, the implications of the COVID pandemic for the design of fiscal stimulus measures. We see two elements. First of all, we see that fiscal policy in general gained significance recently, right? It was before more focused on monetary policy elements. Now fiscal policy is again back in the limelight. And then second, we would argue that the optimal design of the fiscal stimulus measures, they very much depend as well on the evolution of the pandemic. So now, of course, thanks to Michael and others, we've learned a lot about quite some micro behavior response. But so far, there's no really one paper summarizing the COVID-specific multiplier estimates. But of course, the paper by Andreas and Annika are very helpful for us in this context because it summarizes the available evidence. But how do we see it? Now we see, because I mentioned it depends on the evolution of the pandemic. So we see that in the initial phase of the pandemic, it was indeed important to focus on the emergency measures, and these emergency measures were supposed to be temporary and focusing in particular on the health sector to keep households and business afloat and as well mitigate the impact on the economy. Now, when the health-related emergency issues become less important, these type of stimulus measures may become as well less effective. And why? This is because of the lockdown, because it shuts down as well the opportunities to spend. And we have seen here the evidence that the marginal propensity to consume declines and the saving rate increased significantly. Now, if we, in the final step, if we assume that this COVID crisis becomes even long-term, structural would imply a structural change. For instance, it would affect the number of firms surviving from the firms, then these stimulus measures may be even less effective. So again, in brief, the effective or the optimal policy design very much depends on the length and the severity of the pandemic. And here there's a high degree of uncertainty. Now let me, in my third step, give you an overview on the key fiscal policy measures taken. And again, I will focus here on the big picture. First, at the national level, we have seen that member states implemented very sizable budgetary fiscal stimuli measures. According to our forecast, the total amount of these measures is 4% of GDP in 2020. And these measures do not include the functioning of the automatic stabilizers, which come on top, and according to our estimates are about 3.5% of GDP. Now we see that Germany in particular announced a very large, partly as well or mostly implemented a very large stimulus measures by 4.6%, but also Italy, France, and the Netherlands are those countries with the largest discretionary fiscal policy measures taken. From our perspective, it is important that these measures are, first of all, well targeted, but also temporary to boost their effectiveness. And we review and monitor the temporariness of these measures. And in case of if these measures became permanent, this could of course have as well some negative implications for the fiscal sustainability in the medium term. Now, apart from these fiscal discretionary measures, countries also implemented sizable liquidity measures. And these liquidity measures amount to 20% of GDP in 2020. And this is mainly coming from public guarantees, but also in delays to tax collection. And again, Germany is one of the countries with more or less the largest liquidity measure. And of course, the take-up of these measures is unclear. So far, we expect that around a quarter of available guarantees has taken up at the aggregate level. So this has, of course, significant implications for fiscal policy. We expect that the deficit in 2020 is to increase by 8 percentage points to almost 9% of GDP. And we also expect a sizable impact on public debt. It should increase by around 15 percentage points to more than 100% of GDP at the euro area aggregate level. So this brings me to my last point, to the response at the EU level. And I think here we need to be clear, in particular, in contrast to previous crises, the EU's economic policy response to the deep crisis has been swift, comprehensive, and we would also say sizable. I focus now on the two big measures taken, in particular from the European Commission, but of course there are other measures, ECB measures, EIB measures, and so on. I will not focus on them. First measure, the so-called SURE instrument. It means the support to mitigate unemployment risks in an emergency. And the key objective of SURE is to help member states to protect jobs and thus employees and self-employed against the risk of unemployment and the loss of income. And here SURE can provide emergency financial assistance of up to 100 billion in the form of loans from the EU to the member states. This is important. Now, the academic literature more or less stresses that these type of short-term work schemes can be a very important contribution, in particular for three main reasons. So first of all, they can reduce the stress for employees because of the fear for job loss. Second, they can allow for more labor input flexibility. And finally, they can also soften the liquidity constraints of firms. So because of these three measures, we believe that let's say that the tool, the instrument, the SURE instrument was an important contribution to tackle the crisis. Now, finally, we also saw a very large instrument, which is in the context of the next generation of EU, which is the so-called Recovery and Resilience Facility, and it amounts to 670 billion euro. And the main argument is that it should support member states with investment and reforms, in particular to boost green and digital transition, and also to foster the resilience of national economies. So this is more the public investment channel here. We think it is useful. We conducted some simulations with our Quest model, and we see in particular 4 channels which are important and which explain why this has an important impact. First of all, the literature shows a very sizable multipliers from public investment. Sometimes, this is a side remark from my personal taste, quite very high multipliers, right, from the public investment, quite very high expectations on public investment. But this is certainly one channel which is important for the facility. Second, it reduces the sovereign corporate doom loop. Third, it can have an impact on the real interest rate channel. Michael already explained it. It can lead to a more accommodative policy environment, and this can in the end foster inflation expectations and increase the real interest rate, and therefore as well stimulate private consumption and investment. And finally, we also expect some forms of gains from fiscal coordination. And here the main argument is the reduction in debt risks from the high debt countries. So in our model simulations, we see that the RRF increases growth in all countries, but the impact is particularly large in high debt countries. And this is because of the slightly asymmetric nature of the RRF. So I'll stop here, and I'm very happy and looking forward to our discussion.
Thank you very much, Philipp. I hand over to Alexander, who is going to wrap up, I assume. And you promised me, Alexander, that you're going to be provocative, right, in your remarks, and then we get the discussion going. So it's you.
Okay, thank you very much. Thank you very much for having me. I hope you can all hear me. So to wrap up a little bit, or to try to combine the evidence. So it seems like on the one hand side, we have consumers who lost goods that they can consume. These are the income richer part of the population. On the other hand side, we have consumers that are at a liquidity constraint, so the income poorer part of the population, where in principle, we know from the literature, marginal propensities to consume are high. Such any spending program could be very effective, but on the other hand, these consumers face the highest risks and hence probably build the highest precautionary savings. We also know that, as has been brought up by the last speaker, that these spending programs will lead to increases in government debt positions. So then now the question is going back to the title of this session about an effective stimulus package for Europe. How could it look like? What is effective? Effective would mean probably that we need fiscal multipliers bigger than 1. And is that one definition? And then if in a situation where one part of the consumers have lost the opportunities to consume, the other part of the consumers have to build precautionary savings, will spending programs that go beyond extensions of social safety nets, will they be wasteful money that is wasted and just builds up government debt positions even further, given against the background that the young and future generations will anyway be hit hard because they have to finance not only the high government debt positions, they will have likely lower incomes, so they will be hit from two ends. So is it then sensible to go beyond increasing the safety nets, extending some targeted measures, beyond that have more spending programs? So this is the key question that I want to play back to the speakers.
Okay, since you're in the role of the moderator, maybe you pick one that you...
Yes. So let me go in the round of the discussion that we had, and let me start with the first one was Maarten, who gave his presentation and who showed us this evidence on the liquidity constrained consumers on the one hand side and income rich on the other hand side.
Yeah, I think that's indeed the burning question, Alexander. When I think of the many, let's say, short-time work schemes that have been, I mean, they have been, let's say, very popular and was often advertised as the key tool, let's say, keeping the German economy afloat during the great financial crisis. And I think many countries in Europe have sort of copied that let's say scheme. And I mean, my feeling is that was a very good idea to extend this program, because in the end, this is by definition a targeted, let's say, scheme that make sure that people that are most affected by the shock in terms of income are also getting most of the support. And as we discussed earlier, there is really this skewness towards the lower income households that have then arguably higher propensities to consume and who are more, let's say, liquidity constrained. So I think this has in general been a very let's say important tool to save us from worse. But of course, other schemes I think have probably been less effective. I mean, this is my personal view. For example, VAT changes or decreases. I'm not sure to what extent they are targeted in this context that we're just discussing. And I would even argue that I mean, they're also counterproductive on the production or on the firm side, because many companies that should hopefully also benefit from this type of scheme they are not open because they are not allowed, or because people don't want to come in anymore, like restaurants, for example. So to have, let's say, some benefit from a turnover tax change, you also need to be able to generate turnover. And I think in that respect, I would have more reservations. Yeah.
Okay, thank you very much for this. So I think in general, in my view, we should distinguish between programs that help people simply financing their living, that were really hit hard, and other programs that are meant to provide a fiscal stimulus. And you just brought up a critical point on the value-added taxes. So, Michael, given that you have worked on that, what's your opinion on that?
Yeah, so on the one hand, I agree and I disagree at the same time with Maarten, and let me tell you how that can be. So on the one hand, it's certainly the case that many parts of the economy that we typically would think should benefit from such a policy of stimulating demand right now, just by supply restrictions, I would now call it, can actually not benefit from it. So now the question, of course, then is, what is the right time of implementing such a policy? Or given that it was passed already in the past, how could we potentially, try to salvage the policy, and potentially once the economy is reopened again after some vaccination is available, how could actually maybe this VAT policy still be effective? And so if you remember what I said earlier, what this policy aims to achieve is to engineer an increasing path of consumer prices. Now, I certainly wouldn't want to go the way as Hubert Aiwanger by saying, well, we should just extend it, because then the whole policy is useless, because people don't expect an increase in future prices, which would induce an increase in demand. But why should we actually go all the way now on January 1st? So why should we go from 16 to 19? How about we do the following? So we increase by 1% January 1st, by another percent April 1st, by another percent, and so on. And why should we stop at 19? Why not actually go temporarily all the way to 22? And then at the end, you can actually get another boost in consumption, because once you potentially have engineered an increasing path of the price level and inflation, you could then say, well, now we have actually potential space to, at some point, hopefully leave the effective lower bound and use conventional monetary policy again, and we get an additional boost in spending by then saying, well, now we go from 22 back to 19. So this would be a way, once actually the economy is open again and it's safe to go out and consume, to on the one hand stimulate demand, on the other hand helping businesses that are open again, and thirdly might even actually help the ECB to at some point reach its target of close to but below 2% inflation. So very mechanical, but actually also a very straightforward, simple, and policy measure that's not affected by any ways or means of uncertainty, because once the sovereign goes out and explains in simple, clear terms what they're doing and sticks to it, and I would argue that Merkel has the credibility to do so, they could be effective in exactly reaching those aims and targets I was actually laying out.
Thank you very much, Michael. But still, I mean, we have the question is still there. If the value-added taxes is decreased, government revenue is gone, right? So then the question is, will there be more than of the €1 reduced income? Will there be more out of that in the future from the change in consumption behavior? That's the open question. And I'm not sure if the past evidence on these programs, if we can transfer it directly. And on top, and one question I want to also ask you is, you argue a lot with the Euler equation, so with intertemporal shifts induced by price mechanisms. But if we look at the new Keynesian heterogeneization literature, that says much more about, that's not the key mechanism. The key mechanism is who is sitting at constraints, and that can be the poor liquidity constrained people or rich liquidity constrained people who own houses and are therefore liquidity constrained. So is it appropriate to think about this mechanism? So that's one question I want to play back to you, and then I would like to ask Philipp to follow up on his thoughts on government debt positions that are additionally building up due to the spending programs.
Yeah, so maybe just a few thoughts. So you mentioned what's now known in the literature, the so-called Hank model, the heterogeneous agent to Keynesian model. So it's true that through the lens of this model, it's important is especially income effects through second round, old school type. You can think of it like Keynesian multiplier effects, but it's still crucial. Without any form of intertemporal substitution, you wouldn't get any second round effects even in that type of model. And at least from our evidence from a past episode, it seemed to suggest that households were quite willing to substitute intertemporally. So I think I definitely agree with you that you potentially might also have other mechanisms and channels. And in fact, we have been working with the survey of consumers at the Bundesbank, a couple of researchers at the Bundesbank, and Rudi Bachmann and Ralf Lütteke and Benny Born, where we actually write down a heterogeneous H&U Keynesian model to study the effect of unconventional fiscal policy and backing up with survey evidence. And so it looks like the people, as you mentioned, that should be actually more reactive are indeed more reactive to it. Now, one thought I also want to briefly actually put out there, if you think about who are the people that actually spend a larger share of their available income on things that actually benefit from the VAT cut, those are also typically the ones that have a higher MPC because they're sitting on the constraint. So I think actually, at least through the lens of the model, this would actually reinforce this mechanism. And finally, I think what the first point you made, is the fiscal multiplier of this policy larger or smaller than 1? I can just tell you an anecdote. When I got hired in Chicago, I had dinner with John Cochran, and he asked me that very question. He said, well, look, you're in Chicago now, and the fiscal multiplier is always identically 0. So I'm kidding, obviously. But so this is a question we haven't actually studied. And so I don't really feel comfortable now speculating.
Okay, good. Okay, thank you very much for that. But that would mean that there's a lot of uncertainty around there. We do shift a lot to future generations who will have to pay back that ultimately. So, Philipp, what's your take on that?
Yes, thank you, Alex. Indeed, I think you really identified one of the core questions. And indeed, we see a trade-off, of course, because of the future generations may be, of course, burdened by, of course, the higher indebtedness currently. So we think one element which is crucial is that these measures taken are temporary and not permanent, right? And I think, for instance, here, this short-term working scheme instrument, right? It is clearly temporary because it expires unless extended by the council at the end of 22. So it cannot lead to an allocative efficiency or deteriorate the allocative efficiency in the longer term. So this is for us something which is very important. And the second element, I think this has potentially received now in our discussion less attention, are these liquidity guarantees, right? Which are also quite a very important impact. We are not entirely, there's a high uncertainty in terms of what it means for the indebtedness of countries in the future. But we see that this has a clearly a positive impact in our Quest simulations on investment and employment. And it addresses the externalities we see from these constrained firms. So we consider it an effective tool. It's again temporary. Indeed, it may have an impact on debt, but again, over the medium term, it would not hamper the allocative efficiency. So I think indeed there's the trade-off in brief, and measures which are temporary and not hampering as well the medium-term sustainability of public finances should given priority.
Okay, can you be a bit more precise what you mean about allocative efficiency in the medium run, not being affected by measures, if at the same time we see clearly that government debt is going to increase? So
yes, for instance, in terms of, I mean, there's of course a large literature on, let's say, the negative impacts coming, for instance, from too high benefit schemes, right, which may have a negative impact over the medium term on the firm's productivity and productiveness. So if we, let's say, address some of the challenges with permanent measures, for instance, increasing now the unemployment benefits permanently, or increasing, let's say, the length of unemployment benefits, this may have over the medium term a negative impact on the efficiency, right, of the framework. Whereas if we have now short-term working schemes, which are temporary in nature and do not have a impact on the already quite high labor costs in Europe, they may be the better options. And this I mean in terms of the balance between measures, targeted but temporary measures, which do not have a negative impact on productivity over the medium term.
Good, thank you very much. Thanks for this round of questions and answers with me as the moderator. We also have some questions from the chat room, and two of them were provocative in the following sense. One was, are we sitting in an ivory tower that we're talking about Euler equations and Hank models? And is that really the tools that we should use to give policy advice? And the second equally provocative question by the same person is the austerity policy, was that right in the end of the day, or what are the potential mistakes that we should not make again this time? So can I give these questions again to the speakers and again ask Maarten first to comment on that?
Thanks, Alexander. Yeah, I think the more modern models that have already been mentioned, like the Hank models that give heterogeneity, let's say, a serious role in the model and in the transmission of shocks, I think they have had a big impact on thinking about this crisis, and I would say that that they have helped a lot to understand what's going on, and also to really, let's say, use micro data or this aggregate data in a way that you can use it for policy. So so going beyond aggregate data and interpreting also the disaggregate data, I think these models have been very useful, and I would actually be very positive about that. In terms of austerity and whether we may make or repeat certain mistakes from the past, I think now with a vaccine, let's say, at the horizon, I think the message is clear that that we need to make sure that let's say policies work together so that we can, let's say, reach the other end of the river by the time we get the vaccine, and that it's key that macroeconomic policies are sort of compatible, so that we can make sure that the scars of this crisis are minimized, especially for those I think that are mostly affected.
Okay, thank you very much for this reply. Michael, can you also say something on this? Given that, I mean, the two of us started using this limbo.
Well, I guess maybe now to comment on the ivory tower. So, well, I think the good part of the ivory tower, or what we've seen in the last decade or so, is it looks like people in the ivory tower are sufficiently mentally flexible to actually make their models more consistent with data and let actually data inform their modeling choices. And in that respect, actually, I think the policy advice coming out from the ivory tower this time around has certainly been way more informed from how people make actual decisions, to allow for heterogeneity, to go away from the paradigm of a single representative agent who is all available information and fully acts rationally. So I would argue that if anything, actually, we're definitely going in the right direction. And the fact that now pretty much anyone who's now going on the academic job market in macroeconomics, I'm currently reading packages, is actually trying to at least write down models that are consistent with microdata, uses microdata to actually analyze the model prediction. The fact that the ECB and the Bundesbank now have their own surveys of households, the fact that we have now really rich firm level survey data that the Bundesbank is starting to collect is actually an indication that people actually do care a lot about making predictions and policy advice that is informed by how actual firms and households react to policies and how they think about policies. And so therefore, I think actually this criticism is somewhat ill-motivated and certainly is not reflecting the current state of macroeconomics. Now, in terms of fiscal policy and austerity, I think, just looking across the Atlantic and the fact that the IMF has somewhat shifted its gears in terms of austerity, and Blanchard was tweeting last night that he now has a very different view on fiscal discipline, is partially, I guess, another piece of evidence that academic and policy economists look at data, let data inform their opinions rather than having dogmatic views. And so I think that it's definitely possible that those that were in power in the last crisis might actually react differently this time around.
Okay, thank you. We just had another comment going into the same direction in the chat room, and this is again about the fiscal sustainability. If we will have problems because of the PEPP program. So let me play that back again once more to Philipp, asking again, is this a risk that we are running into? What's your take on that? And then we had another earlier question, and maybe some of you feels qualified to answer that, and that is there any good data on the substitution shift on consumption towards online channels? Is that something we could probably explore more in setting up effective policies? So these are two questions that now come up. So Philipp.
Yes, thank you, Alex, and thank you for these good questions. So let me focus on fiscal policy and austerity, also given the time constraints. I mean, we've learned from the past crisis. We're not sitting isolated in the ivory tower, but the exchange with academics, I mean, helps us a lot. And I think one lesson learned is, for instance, the timing of fiscal policy. I mean, we have seen now a very immediate reaction of fiscal policy response at the national, but also at the EU level, which is very special compared to the last global financial crisis. So measures have been taken earlier. And I think also, as I mentioned in my impulse, also more targeted. So, and also I think, for instance, we can see it clearly also in the German stance on let's say, the policy response. I mean, we have seen clear shift compared to the last global financial crisis. So I think, first of all, yes, more positive, the role of fiscal policy perceived, also thanks to the insights from academia. We highly benefit from it. And I think from the last crisis, we also learned that back then, at least in Europe, the contractionary fiscal policy was too early, right? First of all, the measures came too late, and then the contraction started too early. So we had a double dip recession in Europe, not in the US. So I think this, for instance, are two insights which are very important also for tackling the current crisis. Now this brings me to your second question, Alex, doesn't mean we should neglect fiscal sustainability. I think over the medium term, this is very important. And that's why we focus clearly as well on this temporary measure aspect. We've seen now an increase of the euro area debt to GDP ratio to above 100%. Now in the international dimension, the euro area is still, let's say, has rather low debt to GDP ratios compared to with the US, Japan, for instance, other advanced economies, not so much emerging economies, but advanced economies. But still, it doesn't mean we should still keep it seriously and focus on an adjustment path, but probably not too early. This is the lesson from the past crisis. Thank you.
Okay, thank you very much. Given that how far we've proceeded in time, let me hand over back to Andreas, and thank you all for taking my questions, taking the questions of the chat room and answering to those, and for this fruitful discussion from my side. Thanks a lot. And now I hand over to Andreas.
Thank you. I do have the formidable task actually of closing, because we promised to end at 1:30 and it's 1:31. So of course, I have a full list of questions here, and I don't know whether we can go 1 minute overtime, which would be just to think about, we had talked about so many measures and their effectiveness, models, and so on. So maybe to just round this up, a quick comment from each of the panelists. Of course, there's no silver bullet, but if you had 100 billion to spend, what would be on the top of your list? And I'm not looking backwards, but into the future. Let's assume that it's not playing out that nicely. So what would be the stimulus that you would be favoring goal to boost demand? Because that was the initial question. It's unduly simplified the question, but just want to round this up. And given that we heard some opinions on this, so maybe this is the last round and then we stop. Maarten.
Yes, also very, let's say, concise and simplified answer. I would say, I mean, targeted income support. I mean, given the evidence that we've seen. And I think, I mean, also going back to one of the charts that I showed at the beginning, I think overall there, the euro area, if you compare it to the US and what was put in place in the US in the spring, has done not such a bad job. I would say a rather good job. And so that's a bit my takeaway until now. Yeah. Thanks.
Thank you. Michael.
You know, I always wanted to see a helicopter taking off the ECB and spreading money. So now it's maybe time for helicopter money. No, but I can effectively just echo what Maarten was saying. Maybe rather than dropping off over the Eurozone, having it a bit more targeted towards lower income households that have the highest MPC. If the aim is to stimulate consumer demand, would certainly be the most effective policy. To come back a little bit to what Alex was hinting to here and there. Now, something that also actually became apparent now during the pandemic is that, you know, in the US, but also in Germany, the reason why we have replacement rates above 100 is just because we do not have the digital infrastructure to actually have a more targeted policy. So therefore, maybe using part of the money you allow me to spend to actually invest in digital infrastructure for a more supply side policy would certainly be also warranted.
Super. And Philipp, you're last.
Yes, thank you, Andreas. No, I would say we've already spent quite a lot. I pray on the prudent side to, I would say, let's keep it potentially for later. We said the policy response should really clearly be depending on the pandemic. Now, let's have a positive view on the vaccination successes at this stage. And I would say we've done a lot. Let's first focus on the implementation, in particular the EU level measures, the RRF. There's a lot to do. We have to work hard to make it a big success and then potentially adjust later on if need be. Thank you.
Thank you. All right. So thank you everybody for making overtime 5 minutes, especially grateful to the panelists, I guess, on behalf of the entire audience. Thank you everybody for joining, and see you next time around. There's the next part of the 8th Frankfurt conference on financial market policy waiting around the corner. So thank you very much once again. Have a good week and see you soon here at the House of Finance at the SAFE Leibniz Center. Bye-bye.